The average trader breaks a rule and blows up their account. You break the same rule, lose the same money, and have a 4-paragraph explanation for why what you did was actually reasonable. That explanation is the problem. Most people walk into trading assuming their intelligence is an asset, and in almost every other field, it is. But markets have a specific way of punishing analytical minds, not despite how they think, but because of it. So why does a sharper mind consistently betray you at the exact moment it should protect you most? Here is the uncomfortable answer, and it comes early because you deserve to hear it before we go any further. Smart traders lose more because their intelligence makes their mistakes invisible to them. You do not override your plan carelessly. You build a case, a coherent, data-backed, technically defensible case. And that case is exactly what keeps you from ever learning from what just happened. By the end of this, you will see the specific mechanism that turns your analytical strength into a liability, and the one shift that changes it. Think about how the average trader enters a bad trade. They feel the pull. They know it is not quite right. They enter anyway, impulsively, almost guiltily. And when it fails, the lesson is brutal and clear. You broke the rules, you paid for it. Now think about how you do it. You look at the same setup. Something feels slightly off, but instead of impulsively entering or reluctantly passing, you open 3 more tabs. You pull the higher time frame. You find confluence. You recall a similar structure from a few weeks ago that played out perfectly. You check if the fundamentals support the move, and by the time you finish, you have not taken an impulsive trade. You have taken a well-researched deviation from your plan. That distinction matters to you. It probably matters a lot, because it means your judgment is still intact. It means this was different from the other times. Now, the trade fails. And here is where the damage actually happens, not in the loss itself, but in what comes next. The average trader, looking at the rubble, will say, I broke my rules. Painful, humbling, but honest. The lesson lands. You will say, the setup was valid, execution was slightly off, or the market shifted in a way that was difficult to anticipate. Or, most dangerous of all, I need to refine my criteria to account for exactly this kind of scenario. Every single explanation is technically defensible, and every single one leaves your self-image completely intact, which means nothing in your behavior changes next time. Psychologists call this overconfidence bias, the tendency to overestimate the accuracy of your own judgment. But the part most people miss is this. Overconfidence bias does not weaken as you get smarter. It strengthens. Studies consistently show that beginners second-guess themselves. Experts trust their read. In medicine, in law, in engineering, that trust is earned and mostly warranted. In trading, it becomes a weapon pointed at yourself. Because markets do not reward the best analysis. They reward the right position. And the gap between I understand what this market is doing and I know what this market will do next is precisely where smart traders live and bleed. There is another layer here. Your intelligence does not just create overconfidence. It creates sophisticated overconfidence. Justifications complex enough to slip past your own risk management. The average trader cannot reason their way around their rules. You can. And because you can, you do. Regularly, convincingly, and with enough nuance that even you believe it. More analysis will not fix this. A smarter system will not fix this. One constraint will. Whenever you catch yourself gathering evidence, pulling charts, checking macro context, reviewing past setups, to support something you already want to do, stop. Not to think harder. Stop. then ask yourself, if I explained this reasoning to someone who knew nothing about markets, would it sound like logic or like an excuse dressed up in jargon? Smart justifications and desperate justifications are nearly indistinguishable from the inside. The outside view is the only perspective that cuts through your own reasoning. Your plan does not need to be right every time. It needs to be protected from your intelligence every time. There is a version of smart that trading actually rewards. It is not the trader with the deepest knowledge or the most sophisticated model. It is the trader intelligent enough to recognize when their intelligence is the thing doing the damage. Most traders spend years getting smarter about markets. The ones who last spend years learning when to stop thinking. That awareness is not a weakness. It is the most precise edge you can develop, because almost no one else is working on it.